let's pick up where we left off with our budgeting discussion. So after we prepared our sales budget, we did our production budget, which led to our direct materials, direct labor, and overhead budget. So we're right now on the overhead budget. Now what happens with overhead is typically we don't know what all of our expenses are going to be, or I shouldn't say not all of them, but some of them we don't know what they're going to be until after we do the production. For example, the utilities that we incur today, we may not receive that bill for several weeks or even a month after. So we have to have a way to overhead or allocate our overhead, taxes, insurance, some other things, depreciation that may occur when we're manufacturing the product that we don't exactly know what those actual expenses are just yet. So we use this predetermined overhead allocation rate, which just takes our total estimated overhead costs, whatever we anticipate that they will be, and then we divide it by a total estimated overhead allocation base. So we have to figure out a good way to allocate those out. The easiest way is typically by machine hours or direct labor hours. That's kind of the basic go-to standard for how to allocate our overhead. There's many other fancy ways that we can cover in other classes, but for this class, one of those two would be sufficient. So let's take a look at Royal again. They actually apply their overhead on the basis of direct labor hours. So for every, they use a $20 per direct labor hour variable manufacturing overhead rate. So for every direct labor hour worked, they're going to add $20 in variable manufacturing overhead. Their fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs. That non-cash cost, which is going to be depreciation, will come into play a little bit later. So we've got our budgeted direct labor hours. We're going to multiply those times our variable manufacturing overhead rate to get allocated variable manufacturing overhead costs for each month. Then we will go ahead and add in our fixed manufacturing overhead costs to get total manufacturing overhead costs. And you can see here we've got total expected overhead costs of $251,000 with 5,050 hours worked. That gives us an overhead allocation of $49.70 per direct labor hour. Now, if we subtract out the non-cash fixed expenses, that will tell us how much is actually going to be paid out in cash for our overhead, which we will use for our cash budget, which actually happens to be our next budget that we calculate. So our cash budget is going to take into account cash inflows and outflows. So that breaks down to cash receipts and cash disbursements. And then if we're short on money, so we're running low in any particular month, we may have to finance. Typically, companies set that up as a line of credit through their bank. But again, the timing of cash receipts and cash payments is really important. So the cash budget is very important for companies. And the basic format for the cash budget then is going to be, we take our beginning cash balance, add our cash receipts, go ahead and subtract out any cash disbursements we anticipate. And then again, do we need financing? So we'll have to see how much money we have. We want to maintain a minimum balance of cash. So we will go out and finance if we need more money to get an ending cash balance. So the cash receipt section usually is from our customers. So when we are getting sales from our customers, which may be cash sales in the month of sale or collections of credit sales, accounts receivable, which we usually will collect in the following month. Cash disbursements would be payments to our suppliers for materials or to our employees for labor. We've got taxes, dividends, other things like that, and then the financing section. So you typically need to prepare this cash budget in sequence. And I'll show you what I mean by that. I usually start at the top and kind of work my way down each and every month and then flip over to the next month. So we've got Hockey Den sales here. 40% of their sales are for cash. So those would be collected in the month of sale. The remaining 60% are credit sales that are collected in full in the month following sale. So let's look at the cash receipts budget here. So if this is their budgeted sales for those 3 months, remember 40% of those sales will be collected in cash, 60% will be collected in the month following sale. So if my October sales are $100,000, $40,000 of that will be collected in the month of sale. The other $60,000 will be collected in the month following. And we can see that right here, the month following. So we always have to take our accounts receivable numbers, which is 60% of that month's sales. Those will be collected in the month following sale, hence the arrows there. So we can then see what our cash receipts are going to be for October, November, and December. That's going to be important to fill in our actual cash budget. We can also take a look at our cash disbursements for purchases, typically with our customers, our employees, things like that. So Hockey Den's purchases of merchandise are made entirely on account, and they pay for those items in the month following purchase. So the September 30th balance of accounts payable is $58,200. So we've got our October payments balance, November payments, which were for October purchases, and our December payments, which are for our November purchases. And again, that's going to flow into our cash budget. So we've got our cash receipts and our cash disbursements. Okay, so let's take a look at what else we need to know in order to prepare our cash budget. They're going to pay a cash dividend of $3,000 in November. They're going to purchase $25,000 of equipment in December. They have an income tax liability of $20,000, which they plan to pay in October. Their beginning cash balance is $20,000, and they have an agreement with their bank for loans at the end of each month to allow them to maintain at least a $20,000 balance in their bank account. Also, if they have any loans outstanding, the interest is equal to 1% of the prior month's ending loan balance. They repay the loan when their ending cash balance exceeds $20,000. They owe $10,000 currently on that loan arrangement at the end of September, and they have a 40% income tax rate. They will pay the taxes for the current quarter next year. Okay, so we start to fill in what we know. And in this case, we do know what our cash receipts from our customers are going to be and the timing of those cash receipts based on our cash receipts budget for October, November, and December. We also know what our anticipated cash disbursements are going to be for October, November, and December, which we just calculated from the cash disbursement budget. Our selling expense budget, which we didn't talk about, we would have been able to determine how much we anticipate paying our employees in sales commissions and salaries for each month. Also, administrative salaries would come from a general and administrative expense budget. And again, we didn't cover that specifically, but if we did generate one of those, we could fill that in right from our administrative expense budget. So if we go through and we take our beginning cash balance, add our receipts, subtract out all of our payments, including the $20,000 in income taxes, plus the 1% interest rate times the previously outstanding $10,000 loan balance, that means we have $100 in interest. Our total disbursements then would be $94,800. And just to move that out of the way a little bit, so if we had $102,000 available, we're paying out $94,800. That would only leave us with $7,200. Now remember, the company wants to maintain at least $20,000 ending cash balance, so they're going to have to borrow. They only have $7,200 at the end of October anticipated, but they want to keep at least $20,000. So they're going to borrow an extra $12,800, add that to their previous loan balance of $10,000. They now have an ending loan balance of $22,800. We're going to go through and do the same thing. We'll fill in everything else. Again, now we're going to pay out a dividend of $3,000 in November. We have to pay 1% on our outstanding loan balance, so that's an extra $228 outlay in November. Again, take our anticipated cash receipts, add that to our previous balance, and subtract our total cash disbursements. Now we have a preliminary cash balance of $45,072. Well, the company only needs $20,000, so we can pay back some of this loan. Actually, we can pay it all off, which is great, and we'll still have a little bit extra. So even if we pay off all $22,800, given that we had a preliminary balance of $45,072, that'll leave us with $22,272. So we won't have to borrow any more money for December. We can go ahead and fill in December's numbers Remember, they did decide to buy some equipment. That would be in December. That's again going to leave them a little short since they want to keep $20,000. So they will have to borrow again in December, this time $19,628 to get to their $20,000 minimum in the bank. So their ending loan balance, and the whole process will start again for the next quarter. Once we prepare our cash budget, then we can go ahead and prepare our financial operating budgets, like our income statement, balance sheet, statement of cash flows. Now, what's really important here about the cash budget, it does help contribute to better cash management. We need to know what monies we have coming in, what monies we have going out, so we make sure we have enough money on hand to cover those bills as they're coming due. I'm sure a lot of you do the very same thing in your personal life. And it also is going to tell us when we will have excess cash and when we need to borrow some money. So once we finish that cash budget, we can prepare the budgeted income statement. It's based on all of our other operating budgets that we've already compiled. And you can see here where we would get certain things like our sales revenue would come from our sales budget, cost of goods sold from a cost of goods sold budget, which would include direct labor, direct materials, and manufacturing overhead if we were making the product, or from an actual cost of goods sold budget if we're buying merchandise externally. You can see interest and income tax expense would come from our cash budgets. And once we gather all that data, we can just compile the budgeted income statement. Revenues minus cost of goods sold gives you gross profit. Subtract out your operating expenses. It's going to give you operating income. Then subtract out your interest and taxes to get your actual net income. From that, we can go ahead and calculate our balance sheet. Remember what goes on your balance sheet: your assets, liabilities, and equity, your AL. And again, we can see the different accounts and where we actually would gather that information. Now, we haven't gone through each and every one of those budgets in this particular chapter, but if we were preparing a more complete master budget, that's certainly where we will get that information. And then we can compare again, or prepare the budgeted balance sheet, which will give us, in this case, you can see what our anticipated total assets will be, along with total liabilities and stockholders' equity. And finally, we could then prepare our budgeted statement of cash flows, which would include cash receipts from customers, cash payments for operating expenses, interest and taxes. Equipment purchases, remember, fall under investing activities, and then financing activities, which would be borrowing money or issuing new stock. So that's it.